Charlie Gibble, owner of CG Financial Group, your IMO for annuities, life, and long-term care. Hey, why do many consumers today feel that they have been ripped off with their long-term care policies that they bought, say, 20 years ago? Well, of course they feel ripped off because they're looking at these huge premium hikes that they've gotten many years over the last 20 years or so. They see those premium hikes and say, man, the insurance company's taking me to the cleaners. And then they come to you and they say, hey, can we replace this policy with a policy that is much cheaper per dollar of benefit? You run the numbers, or you come to me and I run the numbers, and then we go back and we say, hell no. You actually have quite a good deal here, Mr. Client, even though it doesn't feel like it. But anyway, why have those premium hikes taken place? They've taken place for a few different reasons. Number one is the insurance carriers' interest rate assumptions. We all know that insurance carriers, they invest the premium they get from those clients so that those premiums grow to hopefully a big, huge chunk of money, so that when that client goes on claim, that insurance company has that huge hunk of money. That hunk of money is dependent upon the interest rate. Well, carriers assumed that interest rates and their portfolios were going to be higher than what they actually have been. They mispriced these products. So that is why one of the reasons the carriers have hiked the premiums on these policies. Another reason premiums have skyrocketed: lapse rate assumptions. Lapses. Carriers want policies to lapse their policies. Not necessarily at the beginning of the life of the policy. No, it's good to have the policy in force for at least a few years, because the insurance carriers per policy are not even profitable until, well, that policy is at least a few years old, have burnt off those acquisition charges, i.e. commission, for example, up front. So there's a sweet spot there where carriers say, you know, I kind of hope these policies fall off the books so that we don't have to pay a giant $100,000 a year claim for this consumer to go into the nursing home, for instance. So they assume these lapse assumptions, again, I'm talking a couple decades ago, of like 6%. Oh, every year 6% of our policies are going to fall off. So, okay, so let's do some simple math. So 100 policies are issued this year. Let's say that every year for the next 5 years, 6% of the policies fall up. Just oversimplified here. Let's see, 5 years times 6%. Yeah, 30% of the policies that were issued this year are no longer on the books, and the carrier doesn't have to pay those claims ultimately. And that's way, way, way oversimplified here. But 6% lapse assumptions was common. Is that the case today? No. Which brings me to my point. I believe that policy pricing is more sustainable today for two different reasons. Number one is the interest rate assumptions are much more reasonable than they were 2 decades ago. Number two is lapse assumptions are basically zero that these actuaries are pricing into their products today. They're assuming like none of these policies fall off the books. Why? Because as history has shown, clients, when they buy long-term care, even if they feel that they have been screwed, they hold on to their long-term care policies because they obviously recognize the value. Another reason is a lot of these long-term care policies, these hybrid policies, well, first of all, guarantee the premium, guarantee the benefit, so the carrier cannot change even if they wanted to. But second of all, it's just different pricing. When you have a long-term care annuity and the first money that you're taking from that annuity is your, say, $100,000, behaviorally, consumers just tend to act differently when they have skin in the game, so to speak, versus, man, I've been paying this premium, and if I don't use it, I lose it. Yeah, I stub my toe. I'm going to see if I can go on claim here. So the behavioral thing is another thing. And kind of as I just alluded to, a lot of these policies are almost like high deductible policies, right? A long-term care annuity, $100,000 going in that turns into $300,000 from a long-term care benefit. That first $100,000 that comes out is yours, the client's. And then once you blow through that, then you're in the insurance company's pocket, that additional $200,000 or whatever. It's a lot of stuff in a short video, but let me know if you have questions.